Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are solving a kit question. This is Pavlon company from your the Kaplan exam kit. So we are getting started with this question. Having a read of the requirements first, taking a quick look, we have to calculate the actual or the predicted dividend payout ratio for each year and comment upon the nature of the company's dividend policy prior to the listing. Discuss whether such a policy is likely to be suitable for a company listed on the stock exchange. This is worth 5 marks. Then discuss whether the proposed final dividend of 2.34 cents is likely to be an appropriate dividend if the majority of shares are owned by wealthy private individuals or if the majority of the shares are owned by institutional investors such as pension funds. Now, second part of the requirement gives you additional information. By the end of year 20Y1, the company is forecasting profit after tax to grow by 15% per year for the next 3 years and by 8% after that. So 8% per year after that. Pavlon company's cost of equity capital is estimated to be 12% per year. Dividends may be assumed to grow at the same rate as profits. Assume that 20Y1 total dividend ended up as 7.12 cents and that all dividends will be paid at the end of the financial year. Using this information, you have to use the DVM to give calculations to indicate whether the Pavlon company's shares are currently overvalued or undervalued. Now, this is a 5-mark requirement. Now, let's give the scenario also a read. Pavlon company has recently obtained a listing on the stock exchange. 90% of the company's shares were previously owned by members of one family, but since listing, approximately 60% of the issued shares have been owned by the other investors. Pavlon's earnings and dividends for the 5 years prior to the listing are detailed below. So you've been given with the information. The number of issued ordinary shares was increased by 25% 3 years ago and by 50% at the time of listing. The company's authorized capital is currently $25 million in 25 cents of ordinary shares, of which 40 million have been issued. The market share of the company's equity, the market value of the company's equity is $78 million. The board of directors is discussing future dividend policy. Interim dividend of 3.16 cents per share was paid immediately prior to the listing, and the finance director has suggested a final dividend of 2.34 cents per share. And the company's declared objective is to maximize the shareholder wealth. So this is the question in front of you. Now coming to the requirement number 1, wherein we have been asked to find out the payout ratio. Payout ratio for the years. Alright, so let me create columns over here. 20x6, 20x7, 10, and then 20y1. Alright, so these are the years that I have. Then I also will need to find out the shares in issue. And then I would need the EPS. And then I would know the dividend per share, which is given to me, dividend per share. And then I have to take out the payout ratio. And then I'll also have a look at the growth. So these are the columns which I require. Now the shares in issue is directly given to us, 2-1. This is same in the next year also. And then in the next year you have 2-6. And then again same for 2 more years. And then the last year you have 40 million. So this is the number of shares that you're having in issue. Moving forward to now the EPS, you're already given with the profit after tax. So EPS is nothing but your PAT divided by the shares that you have in issue. So you have all of this working is in dollars. So if you want, you can convert this to cents also. So by 100, if you just multiply, you will be getting your answer in cents, because all of the remainder of the calculation is given to you in cents. So it's good that you do your calculation in cents itself. Now let's talk about the second one. You have 2.4 million divided by this figure multiplied by 100, so you get 11.25. Similarly, 3850 divided by this figure multiplied by 100, and then you have 4100 divided by this figure multiplied by 100, then you have 4450 divided by this figure multiplied by 100. So this is what you've worked out so far to be your earnings per share. Now 5.5 million is the estimate of this year. So we'll be taking this estimate and then work out the similar manner. So this you have worked out your EPS in terms of cents. If you want, you can also mention it over here that your working is in cents. All right, now coming to your dividends per share. So dividend per share is also again given to you in the question itself, 3.6, 4.8, then you have 6.16, then you have 6.56, 7.12. And for the final one, you do not know. 3.16 is what is given to you as interim, and the remainder one is something which is estimated or proposed by your board of directors. The finance director has proposed it to be 2.34. So you add 3.16 and 2.34. So this is your proposed dividend as of now. Now your payout ratio is nothing but the proportion of your earnings that are paid out as dividends. So you're going to take your dividends versus your total earnings, and then you convert it to the percentage format. So your dividends that you are paying is now getting into the ratio that, out of your earnings, how much are you paying out? So this is your payout ratio. Now you can also calculate the growth over here. In the first case, there is no growth. Second year, you are let's talk about how much the growth over here will be. Alright, so for the first year, you are just starting off, so you do not have any sort of growth. Second year, you just compare how much is the growth. So this is what you arrive at, and if you just subtract 1 from this figure, you will arrive at the growth percentage. So 33% is what the growth rate looks like. Similarly, you can drag and drop till the remainder also. So this is what your growth basically looks like. Now, you have done the calculation. Now you have to give the comment. So you have to comment upon the nature of the company's dividend policy prior to the listing and discuss whether this policy is likely to be suitable on the stock exchange. So if you see, they are maintaining sort of a, fixed payout ratio. It's maintained at 42.67 per annum over the 5 years that you see in front of you. Now in general, over here, your a dividend per share can be of a wide variety. Now, because earnings have been rising, although at the fluctuating levels, but the dividend is also growing. However, the growth is inconsistent. In some year, you had higher profits, so the growth was 33%. Next year, the profits were not as high, so even the 42% of the profits gave you a growth of only 28%. So the growth has been a little bit inconsistent. Now, if the share price is affected by your dividend policy, then the fluctuation that you see in the growth, this could lead to a fall in the price of the shares, because the shareholders are going to find out that the company is not a very stable company. Now, if the company is not stable, shareholders are not, going to be willing to invest. So they might be selling the shares in the in the market. So then that could lead to a declining value of your shares. Being a listed company, it is important that they should adopt some sort of a stable or some sort of a rising level of dividend, even when they are having fluctuating earnings. So this is required just so that the shareholders do not lose confidence in the company, because if shareholders lose confidence, panic selling is going to get started, and then the share price is going to tumble down very badly. That's what you will write in the discussion part of it. Now moving further to the second part, where you have to discuss whether the proposed final dividend of 2.34 cents is likely to be an appropriate dividend. The first scenario is where you are talking about if the majority shares are owned by wealthy private individuals. So now the proposed dividend that you are getting is basically a total of 5.5 cents for the year. Now, this will be a very big fall if you see the growth becomes negative over here. Now, if you have the absence of market imperfections like taxation, transaction costs, you will see that, dividend policy does not really affect the wealth of the shareholders, because it's the future earnings which is important and not how much they are paying as dividend and how much they are retaining. But when you have the, taxation, personal needs of the people, so private individuals, they might be paying higher tax rates, on income tax rather than capital gain tax, due to, some of the exemptions which are available on capital gains. So they will rather prefer retention. That means that the company retains more money in the company itself rather than paying that as a part of dividends. Uh, However, this will lead to them not being very disappointed with the cut in the dividends. So they'll not be very sad about this. However, they may prefer income to capital gains. That means that they will prefer that this comes as a part of income rather than capital gains, because this will help them to manufacture homemade dividends. What do you mean by homemade dividends? Homemade dividends is actually when the company is not paying any dividends, so you end up selling shares, some of the part of your investment, just so that you're able to make some sort of money. So that acts as a homemade dividend for you. Now, if the majority of your shares are held by the wealthy private individuals, then it may be possible for the company to explain the background of any reduction in the dividend to gain acceptance of the shareholders. So if these are people who do not really mind, then the company is going to give them justification that, hey, listen, we have cut the dividend, but we are going to do this good thing with the business. That's why we are cutting the dividend. So they might be understanding and they'll not be selling the shares like crazy in the market. So this is it about the wealthy private individuals. Now, if your majority of shares are owned by institutional investors like pension funds, so basically they are going to get affected because they want a steady flow of income, because they want to meet their day-to-day obligations, and they would not be, very happy with generating the homemade dividends also. So, if they are not very happy with the new dividend, they might want to sell off their holdings, and if institutional investors sell holdings, it ultimately affects the share price very badly. So overall, you will also have to write a conclusion over here, because this is a 10 marker requirement, that there is no conclusive evidence on what makes for an optimal dividend policy. It is for them to decide how their shareholders are going to react and then take a decision accordingly. Now coming to the second part, here you have to use the DVM to give the calculations to indicate whether the shares are currently overpriced or underpriced. So here it's not directly possible to use the DVM, because DVM takes only one growth rate which goes on till perpetuity. However, if you see the question over here, it tells you that the growth rate is going to be 15% for the next 3 years and then 8% after that. So now your calculation also has to be split into two parts. If the company's profits and dividends are expected to increase initially by 15% per year, then the investors will expect this year's dividend, which will be paid at the end of T1, to be how much? You'll say that if, currently they are paying 7.12. So 7.12 needs to grow by 15%. So your dividend is going to look like 7.12 multiplied by 1.15. So this is what your dividend should look like. Now, how are you going to value the first 3 years dividend? Value of first 3 years dividend. Now the first year is 20 y2, then you have 20y3, then you have 20y4. So these are your first 3 years. Now, how much are your dividends? Your dividend for the first year we just calculated. This figure will come right here. And then in the next year, it's going to be again a 15% rise from here. So it's going to be 9.416. And then similarly, it's going to be a rise of another 15% in the next year. So this is what your dividends are going to look like. And if I want to find out the present values I have to take at the rate of 12%. So 1 by So this is how you will be getting your annuity factors. You can just copy and replace this by 2 here, and then you can again copy and replace 2 with 3. So this is how you can arrive at the annuity, present value factors. If you want, you can also take help of the PV table that's available to you in the exam also. So this is how you will work out the present value of the dividends. Now you'll just have to add all of them to arrive at the final figure. So this is what your total dividend for the first 3 years is going to look like. The value has been already brought to the present value. Now you're going to do the second part of the calculation, which is value of dividends year 4 onwards till infinity. 4 onwards to perpetuity. Now, how are you going to value this? You have a very simple formula for calculating till perpetuity. You use D into 1 plus G. So, your very last dividend which you have calculated is this one. My apologies. This needs to be multiplied with 1 plus G, your growth rate, which is given to you as 8% over here. So, 1 plus 8%. This whole needs to be divided by the cost of capital, which is given to you as 12%, minus the growth rate. So the growth rate is again 8%. So this is how you arrive at the value. Now the value that you are getting, this formula is going to discount the cash flow back by one time period. Now this is the value that you're getting at time period 3, but we are calculating whether the share is overpriced or underpriced at year 0. So we have to bring it back again to the figure which it should be valued at today. So this is the figure which is going to happen after 3 years later. So what I'm going to do is I'm going to use the year 3 annuity, the present value factor, which I've just calculated this over here. So this needs to be discounted and brought to the present value in today's terms. So this is 208.1.053. Now this is what you are getting as the present value. Now the value of the share, as we have studied, should be equal to the present value of all of the future cash flows. So 22 plus this figure over here, this gives you 30.6 cents. So if you see, let's also find out what's the current market value. Current market value per share, if you find that out, you will find that 78 million is the value that you are given as the market value of the company, and this needs to be divided by the number of shares, which is 40 million. So you can say $1.95 is what the share price currently is, but if you convert this also into dollars, this is 230 cents. So if you convert this into dollars, you're going to get 2.306. That means the share is worth 2.31 roughly, and you are currently getting it in the market as 1.95, which means that the share is under value. This is how you solve the second part also. With this, we are done with this question. I hope that you found this video helpful. Thank you so much for watching.